Hey everyone, welcome back to another dividend investing video. 2024 is off to an interesting start to say the least. On January 4th, we saw Walgreens, ticker WBA, announce it was cutting its dividend by nearly 50%. Walgreens was a dividend aristocrat. Now, if you've been a regular watcher of this channel, you're not surprised by this news as we got out of this one last year. This week also saw healthcare REIT Medical Properties Trust continue its slide. After reporting they were ramping up efforts to collect their outstanding rents from one of their main tenants, and this saw their stock drop more than 30% in one day. Investors have gotten destroyed on both of these companies. Like, if you chase yield and ignore fundamentals of the business, you can get burned. And in today's video, I'm going to talk about these two stocks a little bit and just share some thoughts on how to hopefully avoid investing in stocks like this. So let's get right into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So first, since this is my first video of 2024 and we have our investing challenge going on, I'll take a quick second to show you my progress for the first week. I am buying SCHD every Monday on the first day of the market open in my Roth IRA. On Tuesday, January 2nd, I purchased one share of SCHD for $76.71. That price sure has climbed up, but this is a dollar cost averaging plan where we're just focused on building the position and we'll catch the average price over the course of 2024. Which I believe in, say, 2030, 2034, will have been a wise decision. I'm also buying a weekly share of S&P 500 Index SPLG. I'm buying this on Friday, or the last day of the market, also in my Roth. I don't have fractional shares in my Schwab account, so the reasonable share price makes this a great candidate to buy a share every week. S&P 500 is a no-brainer. On Friday, January 5th, I purchased one share of SPLG for $55.29. So these will make up the majority of my Roth investments for 2024. I'm going to mostly stay in these ETFs. Of course, I'll keep you guys posted on where this is at every week, and you guys can do your own challenges as well. Just click the link in the description on my 2024 52-week investing challenge. In that video, I have a tutorial on how you can obtain and use this very spreadsheet for your own tracking. All right, so let's talk about chasing yield and what has happened with Walgreens Boots Alliance and Medical Properties Trust. How much consideration are we putting into the yield of a dividend stock? It's something we should ask ourselves. I think this answer to the question will vary, but I'm going to argue for the majority of us, it really should not be a major consideration in your investment. If you're investing your hard-earned money, you want to put this into quality businesses that's going to preserve your capital. I would say neither Walgreens or Medical Properties Trust fit my definition of quality businesses. Definitions are going to vary here. And guys, I owned both of these stocks last year in 2023, smaller positions in both, but I sold out of them once I really recognized these red flags. And when I did recognize them, I shared them with you guys. So why did I own them? Honestly, I wanted to up the dividend yield of the respective portfolios I held them in. Simple as that. But why? I'm not in a position to live off dividends right now. I'm simply reinvesting in them right now. So in my taxable YouTube portfolio, what I do is I drip automatically reinvesting the dividends. And in my Roth IRA, I take the dividends as cash and selectively reinvest them in places that I choose. There is merit to doing either reinvesting strategy, but the idea is you reinvest your dividends, unless you're deciding to use them for income. And at that point, then sure, perhaps yield becomes more of a consideration. But as I know many of you are building your portfolios, your passive income stream, I would suggest it's way more important to focus on quality businesses. These are businesses with moats. They have growing free cash flows, high return on invested capital. Hopefully they're buying back shares, and they're consistently raising their dividend. And can you reasonably expect them to keep raising it is a question you must ask. Whether it's yielding 1%, 2%, 3%, I think in this stage, it's much less important than any of those above criteria. And in 2024, I'm likely going to move on from a couple of the other higher yield stocks in my portfolio that don't offer very much in the way of growth because I have time for them to grow. There needs to be a good reason for buying a stock more than just the dividend it's paying you. Paying fat dividends is great, but you want to build a passive income stream on a solid foundation where you're not going to have to worry about dividend, or you're much less likely to worry about a dividend cut in the future. So Walgreens, cutting that dividend by 48%, going from 48 cents a quarter 25 cents per quarter. The writing was on the wall. I sold out, I think it was like back in August, September. Now, year to date, I'm talking like 4 days, shares have dropped 9%. They actually beat earnings with better than expected beat on revenue by $1.6 billion, which was 10% year-over-year growth. Wall Street did not like the news of the dividend cut. Shares dropped on the news of the dividend cut. And ultimately, this was necessary, though, for Walgreens to be able to turn this around. Before the cut, shares were yielding close to 8%. Shares are 29% lower than they were 1 year ago. Over the last month, they did regain some of those losses, but like most stocks did. But on the news of the dividend cut, shares are back down. On the 5th, Barron's came out with an article suggesting that Walgreens could be set to be removed from the Dow Jones Industrial Average. It is now the smallest market cap and lowest stock price on the 30 stock index. And it would not be surprising at this point, since joining the Dow in 2018, Walgreens has dropped 65%. Shares are 65% lower than they were 5 years ago, 60% lower than they were 10 years ago. Here's the thing about retailers. This is true for all of them. They have really low margins. Even the mighty Costco, ticker COST, boasts a 4% margin today. This is what's left from operating income after the company pays for the cost of goods sold and all of its operating expenses. Now, Walgreens margins have steadily declined, being around 5% up until 2019 when it started to drop, and today they have a 1% margin. That's their operating margin. And while their revenue may be at an all-time high, they can barely turn a profit right now. And their debt situation is, let's say, not ideal. We have a net debt to EBITDA of 3.58 and a net debt to capital of 54%. This chart illustrates just how easily Walgreens can meet its interest expenses from its operating income. This divides the operating income by interest expenses because if a company is using a bunch of money to pay its interest, that's going to add pressure to the dividend. And they have to take care of this debt. The prior dividend was costing Walgreens $1.96 per share annually. Free cash flow was negative 61 cents in 2023. Free cash flow charts should look the opposite of this if you're making an investment. You can't grow a dividend without growing free cash flow. And if it trends in this direction, you end up cutting the dividend. Now, shares are yielding 4% right now, right in line with their 5-year average. 48 years of dividend growth have come to an end. Walgreens, now a former dividend aristocrat. This is a chart that also should have set off some red flags. Dividend growth was looking great until it didn't, and it slowed to a crawl. Maybe this is where Walgreens turns it around with they're able to invest in their business now. We will keep watching it. The stock could very well be undervalued and ripe for a hefty turnaround. The dividend cut might give them a fighting chance, but I won't be interested in investing in this business in the foreseeable. I need to see it to believe it. And then we had MPW. This is a hospital REIT. They are paying huge dividends, is attracting a lot of investors, wanting a piece of those. But it got cut back in October from 29 cents a quarter to 15 cents per quarter. And I think another dividend cut is on its way with this one. Throughout 2023, Medical Properties Trust was having trouble collecting rents from one of its largest tenants, that's Steward, who make up about 20% of their company's revenue. Steward is about $50 million behind on rent payments. And last night, on the 4th, MPW announced a bridge loan of $60 million was being issued to their struggling tenant. And this is a company that is in a ton of debt right now. The net debt to EBITDA of 8.68 and net debt to capital of 0.5. There's no guarantee that MPW is going to ever get squared away from their struggling tenant Steward. And they are looking to offload some of those properties, I think. On the news, shares dropped 29%. They just absolutely shit the bed today. This is hitting penny stock territory, $3.55 a share at the time of publishing. Over the last year, shares are down 70%. This is extremely difficult to come back from. The thought of most investors breaking even on this kind of loss, this is not even practical. I cut my own losses on this one last summer. Now, shares are yielding 16.9%. This is post-dividend cut. That's 198% above its 5-year average. Look, if you're buying this, you're basically gambling at this point. Even after the dividend cut, I highly believe there's going to be another dividend cut in the near future. And the company reports earnings on February 1st, and we'll keep you posted on this as well. Hopefully none of you were burned too badly by either Walgreens or MPW. And dividend cuts are not always the end of the world. Let's look at Intel, ticker INTC. In 2023, they cut their dividend early on. They invested in their business. Shares have responded by rising over 70% in the last year. But they're competing with the likes of Nvidia and AMD, two formidable companies taking up some of their market share that Intel has been losing. So we will see what happens with them as well. Guys, the moral of today's video is buying quality businesses Avoid yield traps like Walgreens and medical properties trust. I'm going to do my best to help identify the good from the not so good, so make sure you are subscribed. I'm working on wrapping up my top REITs for 2024 video. I've been working on it all week. That will be out shortly after this one. In the meantime, check out this video where I review my public taxable dividend growth income portfolio. We're growing here on the channel. I go over all the stocks I purchased in December and the dividends I collected. I had a record month of dividends for this account. I hope you guys enjoy, and until next time, keep investing.